We're going to look at three companies today that reported their earnings, and the first one is going to be Taiwan Semiconductor. Now, this is a huge company in the semiconductor industry and has a lot of ramifications, which we will discuss. The other company we're looking at is Elevance Health. Now, again, this one is in the healthcare industry, very similar to United Health that we did analyze not too long ago. And third and finally, we want to cover Crown Castle CCI in the telecom space within the real estate investment trust. Each one has certain ramifications for its own industry that are very important to understand. And the first one we will look at today is essentially the semiconductor industry. Now, Taiwan Semiconductor have reported their earnings, which we are going to cover, but over the course of the last few hours with the market open, we can see a lot of companies that are in the red. Although we do see the likes of Nvidia up marginally 0.86%. However, Qualcomm down 1.3%, Texas Instruments down 1.2%, NXPI down 3.2%, and so on and so on. We're going to take a look today at three companies, as we mentioned, not just their earnings, but we're also going to take a look at the strength of each one of these. We'll investigate their dividend safety as well as their financial metrics, looking at their free cash flow. And with each one, we are going to run them through the valuation so you also understand what is their intrinsic value after the analysis, what is our acceptable buy price, what is that margin of safety that we've used, and whether or not Wall Street also believe these are companies with a lot of upside that you should consider for your own portfolio. Now, yesterday we did run through the earnings of ASML. Now, we mentioned they are essentially a monopolistic company in the semiconductor industry that essentially supply the machines for companies like Taiwan Semiconductor, like Samsung, and like Qualcomm to make those chips that they manufacture. Now, they are continually down, in fact 1%, as they were down around 6 to 7% yesterday, so they are starting to fall even further. And if you want to check out a comprehensive analysis of this company, we did review them yesterday as part of our earnings. We also have Qualcomm. Now, again, in the semiconductor space, they are down around 0.7%, and we're going to investigate whether or not this is something that is across the board and something we really need to consider if we are looking at adding companies in the semiconductor space. Now, let's jump off into the earnings of Taiwan Semiconductor Manufacturing. Straight away, what we can see, a few key points to note. They did beat on both the revenue and on their profits, and they do signal a lot of this due to be some strong AI chip demand, which is positive news. When we looked at ASML yesterday, they in fact were talking about the opposite with some slowdown. Now, TSMC, they are in fact the world's largest producer of these advanced processors, and some of their customers are the likes of Nvidia and Apple. So it is very, very important to understand. If the demand is increasing, that is a positive sign. If demand is slowing down, then we may also see slowdowns from the respective companies and their own top-line revenue numbers as well. Now, they do essentially note a lot of this demand is coming for the AI chips due to large language models like ChatGPT and some very similar ones in the Chinese industry. In terms of the actual numbers that they did report, well, as we mentioned, they beat on both top line and bottom line. 592.64 billion in new Taiwan dollars, and that was against analyst expectations of 582. We can also clearly see they did beat on the bottom line quite significantly, 225 versus 213. Now, on top of that, not just beating analyst estimates, which is always positive, but what we really want to understand is, did they beat from the prior year? We can see TSMC up from prior year 16.5% on a net revenue basis, and we can also see on a net income basis they are up 8.9%. So very nice to note, they are a company that does essentially supply these processor chips to the likes of Nvidia, the likes of Apple, and they are, as we mentioned earlier, around 1/3 of the income stream of ASML. So very interesting to note. And what I really want to point out from all of this information, they beat on the top, they beat on the bottom, they also beat in comparison to the prior year. We have this company down. It was around 5%. It is now recovered slightly, negative 3.55% on the day after reporting, which what did seem to be fairly strong earnings. Now, when we take a look at this company in detail, we can straight away see one strong buy signal and two buy signals from Wall Street and Seeking Alpha analysts. This is a company that has been up incredibly 52% over the last 12 months. It does trade in the mid to upper end of the 52-week range, with a trailing 12-month yield of 1.39% and a forward PE that sits roughly in line with the same of the S&P 500 at around 22.2. Now, if you've been a holder over the last 10 years, we can see you would be up around 573%. So a very strong performance for those long-term investors. Bear in mind, it doesn't include those dividends reinvested. So let's take a look at the company itself, whether or not it looks to be undervalued, if it is a strong company that you should consider for your portfolio, or if you are someone who just holds it and wants to know if it is still good to continue to hold. So straight away, dividend safety score 62, it does look to be safe. Market cap 643 billion. It is a mega cap company. Now, in terms of the last recession, the major 07-09 crash, they in fact cut their dividend. They didn't increase it. They also didn't maintain it. They had below average growth, negative 26%, with the S&P coming in around negative 12 on average, but they did significantly outperform the S&P whilst it dropped negative 25%, the S&P itself coming at negative 55. One thing that is very strong about this company are those increases to the dividend, double digits just last November, double digits over the last 5 years on average, 18% over the last 20 years year on year, and we can see they have only been increasing those dividends for the last year. As we can take a look above on the graph, they did in fact maintain that dividend in 2021, but they have been paying a dividend for the last 20 years. In terms of dividend yield theory, now it does state the company is undervalued when the current yield sits above the 5-year average. Purely on dividend yield theory, we have an overvaluation signal. However, on the forward PE, as it sits near enough with the 5-year average, we have reasonable valuation signal. However, when looking at the sector PE of information technology at 25.4, it is higher than that of TSM. So a few things to note, and the most importantly, however, that we don't look at any of those models in singularity, and will conclude towards the end. As always, free cash flow payout below 50% if you do want to focus on semiconductors. Personally, a blanket rule that I use of 60%. That does give me faith that management can offer those double-digit dividends that we love to see. Now, in terms of looking at this, what I would say over the longer term, it is a bit of a worry. 2023, 118%. This essentially signals that FY23, they paid out more in dividends than they generated in free cash flow. This is one of the reasons why I do say ignore earnings. If you looked at that in 2023, you'd be quite happy with that. You'd be saying that, it's below the 60%. However, we do prefer to look at the free cash flow payout as well. Earnings is susceptible to manipulation by management through accounting. The positive to note here is that it does come below to around 63% in FY24, but do keep a note of the free cash flow payout. It is very, very inconsistent. In terms of the growth of the free cash flow, one of the most important metrics, we want to see continued growth year on year. Whilst it does increase, we also note a lot of inconsistency. FY24 expected to increase quite rapidly, in fact more than double. But again, you can argue this is a fairly cyclical industry, hence why the inconsistency noted. In terms of sales growth, while 3 to 7% for that steady moderate growth, we can in fact see over the longer term, they do have some very strong growth. In fact, double digits very nicely over the last 3 years, or from 2020 to 2022. The more recent year, though, there was a negative 5% drop to their top line revenue, and we can see over the longer term, they have nearly increased their top line by 3 times. One thing we would say, their shares outstanding, they do 0 share buybacks, is very constant over the longer term. What we'd ideally like to see a decrease in graph so that we can see that excess cash returned through those share buybacks. In terms of ROIC, above 12% for semiconductors, ideally I would say a minimum of 10%. Just to give you faith that management are able to effectively allocate their capital. They're consistently in the low 20s, very strong, no issues whatsoever from that metric. And when we look at their operating margin and their free cash flow margin, well above the minimums on both operating and free cash flow, fairly consistent as well. So I would say with this company, you wouldn't need to worry about those margins unless something really, really drastic did happen. But as always, year on year, quarter on quarter, these are metrics that we do tend to analyze anyway. So this is covered through this analysis. Net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, below 1.5 for semiconductor firms, 0.0000 every single year, and expected next year. This signals that they wouldn't even take them 1 day to pay off their essential debt, net of cash on hand. So they have a phenomenal balance sheet. And whilst we see a 0 here over the last 10 years, the reason why we don't see a very safe dividend score is when we looked at the free cash flow payout, it is very high. Some years it is in the triple digits, so something just to be aware of, but we can see they do hold a very strong balance sheet. Now, in terms of the valuation, let's take a look. And as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we do run through every single one of these models and do a deep dive. Today's episode, we're going to jump straight into the intrinsic value. And for today's episode of TSM, we do get a $153 intrinsic value. With the current price around $132 after the drop today on the earnings, we always use a margin of safety starting point at 10% and we execute if it meets the 3 golden criteria. As always, they don't change. They have to be a wide moat, strong financial metrics and good forward-looking data. So 10% a buy up to 137. At 15%, we can see it isn't quite a buy yet, but really not too far off having that 15% MOS level. With the drop today, it could certainly hit that as well. In terms of Wall Street and their price forecast, well, they have a target of $150, slightly higher than our intrinsic value with upside of 17%. As always though, do let us know your thoughts below. A lot of people may not like this as you do get that geopolitical and regulatory risk, which could in fact be part of your margin of safety, although this does depend as an investor whether or not this is something you include in your thesis. The next stock that we are looking at that reported earnings this morning was Elevance Health. Now, this is one that I do hold in my portfolio. If you are a regular viewer, you will know we have done videos where we run through Elevance Health. It is one that I hold as well as United Health Group. Now, this one, they reported their earnings. They are up 5.5%. And on top of that earnings, we do see that UNH, following even their earnings yesterday, they are also continuing their strong momentum run, up 4% as well. Now, specifically today's episode, we're focusing on Elevance Health as we did cover UNH not too long ago once they reported. We can straight away see 1 buy rating, 1 strong buy from Wall Street and 1 hold. So quite mixed. And when we take a look at their earnings itself, well, the headline does read essentially that Elevance did raise their forecast after the industry cyber attack, which we did see on United Health's unit. Now, in terms of the numbers, well, their profit came in at $10.64 a share, which was above what analysts were targeting at $10.53. And on top of that, they are forward-looking, expecting their adjusted earnings for the year to be higher at 10 cents increase from their previous forecast. So nice to know with that beat, as well as increasing their guidance, that has helped this company and the industry as a whole, as there were a lot of worries essentially with that cyber attack and the futures of these companies moving forwards. Now, in terms of the numbers, well, they are up, as we said, 5.6% over the last 12 months, up 9%, and they are right now trading at a 52-week high. Very nice to note for shareholders as well. In terms of their yield, 1.28%. Forward PE very low, especially compared to UNH at 13.7. And we can note as well that it does have a market cap of 118 billion. So let's take a look. How has this done over the last 10 years? Well, it is up 447%. When we look at their dividend safety score, well, 99, very safe. Market cap 118 billion. It is a mega cap company. In terms of the recessionary metrics, well, they did have negative 4% average growth during the recession, so slightly above average. In fact, they also marginally trailed the S&P negative 61. In terms of dividend growth, well, double digit just this year. Love to see that as a dividend growth investor, and over the last 10 years, increasing 15% year on year. They have also been increasing those dividends for the last 12 years. Dividend yield theory then, let's take a look. We do get a sense here now of reasonable valuation with the yield as well as the forward PE pretty much in line with the 5-year average. And when we do compare it to healthcare sector, it is a little bit higher there at 17.4. So let's take a look at their free cash flow payout. Remember, this is what we do focus on, that blanket rule as well. Very, very low, which is why there's no surprise every year why we do get those double-digit dividend increases. Remember, you want to be spotting these essential themes throughout these companies that we review that are high quality. What do they all have in common? The first one, especially for dividend growth companies, they have a low free cash flow payout. So below 30% every single year, bar 2018, 2024 at 17%. So I would be shocked if next year, January 25, we don't see another strong double-digit dividend increase. Also, they have been increasing their free cash flow over the last 10 years. Yes, it is pretty inconsistent as we can see. FY24 though expected an increase to 37.40. Terms of sales growth, very nice. In fact, higher than the 3 to 7% nearly every single year. The last 5 years are very strong for this company as well. And numerically speaking, we can see it has gone from 74 billion to 171. Now, something that United Health don't do, that Elevens do, is that shares buybacks over the last few years. In fact, over the longer term, we can see consistently. It might not be a large amount year on year. Nonetheless, it is something that they continue to stick with. ROIC, again, very healthy over the longer term, pretty consistent, and you could argue, in fact, it has been increasing over the long term, even though it is just a few percentage points. Still very strong, very attractive as well for future investors as well as current shareholders. Margins are very typical in the industry, so it may not be fair to look at a blanket rule of above 12%, as when we looked at UNH, it had very, very similar numbers. And the same goes for the free cash flow margin. Even though it isn't around that 5% we want to see as a minimum, they are still increasing over the longer term. Finally, net debt to EBITDA, exactly the same as TSM, which we did explain. Very, very strong balance sheet, no worries. The difference with ELV here than TSM is the fact that when you do take a look at the free cash flow payout with ELV, it is much, much lower, much more consistent, and that is why it gets that very safe dividend score. So let's take a look at the valuation. Again, this is one that has popped after the earnings, so it may not be as discounted as maybe it was just a week ago. The intrinsic value then sits at $572. Do bear in mind you can grab a copy of this valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list by clicking on the pinned comment below. 10% margin of safety, then you would have to wait to $515 if you believe it will go that low. So right now it does have around a 5 to 10% MOS level. So do consider that it may be a premium company when you do look at the metrics, but you always want to have a strong margin of safety. Again, every investor's number will be different depending on their own investment analysis. In terms of Wall Street and their expectation, well, over the next 12 months, they still see upside of around 12% with a price target of $583, higher than what we've calculated as our intrinsic value. And do let us know your thoughts whether or not after these increase to their earnings on the share price, they are still buying or whether or not you are still holding. Now finally, before we do move on to the next one, just to let you know, we have released our latest free weekly articles. Our more recent one, we look at 10 stocks with massive upside. Again, we do run through undervalued stocks. If you want access all completely free to any of these articles as well as many others, do click on that pinned comment below and you can start reading. Now, in terms of Crown Castle, again, this is a telecom REIT. We'll also have a quick look at American Tower Corporation. They did release their earnings, and we can see with their earnings, they reported $1.64 billion in revenue for the quarter ending in March 2024. Now, not the greatest when you do compare it to a year-over-year decline of 7.5%. Conversely, though, when we look at their earnings per share of $1.72, the same period last year was 97 cents. So revenue not looking that great over last year, earnings per share looking a lot better. In terms of how it was versus analyst estimates, but we can see a positive surprise both on the revenue and both on the earnings per share. Now, how has that affected this telecom REIT? Well, firstly, we can see not massively. It is up by around 0.37%. And when we look at AMT, which has been battered heavily over the last year, it is pretty much looking flat. So the earnings, whilst it was a beat on both accounts, there wasn't really much for the market to take a look at that and continue or in fact reverse the trend that it has, where it has been pretty much down over the long period. So let's find out. This is one that does look very, very discounted. As we can see though, just one buy with two holds. It is trading towards the lower end of the 52-week range. It does have a fairly high yield now, not too far off 7%, and a P to FFO of 13.7. If you've been a shareholder though over the last 10 years, you would be up 28%, but we can see the all-time high is around $209, quite some way away from that $93 mark now. So let's take a look at the dividend safety. It is 60, borderline safe, market cap 40 billion, a large cap company. Terms of the metrics from the last recession, well, they had above average growth and a pretty much a near S&P return. Now, they haven't increased the dividends so far, so we are waiting on that. However, over the last 5 years, it has increased 8% year on year, and they have been increasing those dividends for the last 9 of them. Now, Dividend yield theory, we can see a massive sign of undervaluation, both on the yield, which is 6.7, significantly higher than the 5-year average, as well as the forward P to AFFO, 13.6, which is much lower than the 5-year of 23. But we do note it isn't too far off that real estate average of 13.1. Now, in terms of the adjusted funds from operation, remember this is what we look at because for REITs, real estate investment trusts, free cash flow a lot more volatile. Below 90% as opposed to below 60% for other companies on the free cash flow, we can see not only has it been increasing, but it is expected to be around 91% in FY24, something to consider and probably something you do want to factor into your margin of safety. Adjusted funds from operation, well, it has been increasing over the longer term, although we do want to point out FY24, they are expected to decrease to around 686, and you can see percentage-wise over the next 12 months, negative 7%. In terms of the top line for REITs, we do want to see 5 to 10%, whilst it has been around that over the longer term. FY23, it is flat, and numerically speaking, we can see they have pretty much doubled their top line. With REITs, as we always say, they will always dilute your position. It is something they need to do. They need to essentially issue equity so they can fund their property acquisitions. This is because they don't hold a lot of that internally generated cash flow. They pay it out as dividends. As we can see though, I would compare it to other REITs we've reviewed on the channel. It is a massive dilution when you compare them. Now, in terms of ROIC, looking pretty strong. Whilst we look at 10% or more for normal companies, REITs 3 to 5%, and we can see here clearly it has been very strong on this metric, last 2 years at 7%. Operating margin as well, healthy in operational efficiency over the longer term, with that increase from 28% to 36%. And finally, the net debt to EBITDA, which is very important for REITs, earnings before interest, tax, depreciation, amortization. Below that 5.5 is what we want to see. And in fact, we don't see it consistently over the longer term. What we want to point out is due to that borderline safe dividend score that we saw above, it is expected to go higher at 5.75. So not just include this in your investment thesis, but see whether or not you do want to hold a slightly more riskier REIT. It does have a nicer yield, but again, do factor in if this does continue to increase, there could be a possible scenario of a dividend cut in the future. In terms of the valuation though for Crown Castle, let's take a look at the intrinsic number, which is the average of these three models. It comes to $132. Now, in terms of the current price, $93. Margin of safety, 10%, remember those three golden criterias, and then we keep going till it's near the current trading price, and we can see for today's episode it does hold a fair amount. In fact, not that far off a 30% MOS level. In terms of Wall Street for this REIT, what we can see here, $120. It has been lowered from previous episodes where it was slightly higher, but they still do believe a 29% long-term target for this REIT. As always though, do let us know your thoughts in the comments below, whether or not you're adding to any of these companies, whether or not with their earnings it is making you think differently about investment into semiconductors or any of the other industries. And what we would say right now, the healthcare sector does look quite strong, especially ELV as well as UNH. So let us know if you have been buying those over the more recent period. And finally, just to let you know, as people do tend to ask, this is Seeking Alpha that we use for a lot of our analysis. If you do want to get essentially a subscription with a lot of this data so you can take a look at a lot of the information without being restricted, you can click on the pinned comment below where they are offering essentially a 20% discount for subscribers. As always, if you enjoyed the episode, smash that like button, hit that subscribe and bell button. We'll see you all on the next one, and for now, take care.